So the chance of it is higher than 2021, but it still wouldn't be my base case. I mean, my base case would be kind of choppy consolidation. I don't know if we're going to go to higher highs or if we're going to, just kind of stagnate. We could have a drawdown. Basically, when you have such a strong year, and then you have a pullback of fiscal monetary support, that can put some pressure on markets. And so a crash would not be my base case, but weaker market conditions would be. The ways to protect against it are to own some cash or bonds as a non-zero position so they can rebalance into the weakness of things you want to own, or to be long volatility, or to have other specific hedges, like some puts or some long volatility plays that basically pay off if you get that downward volatility, that you can then use those gains to rebalance into, again, some of the assets you actually want to own. And so I think overall it is a time to be, somewhat defensive, which doesn't mean get out of everything that you want to own, but it means basically expect that it could happen so that you're not shocked if it happens, and that you're ready to take advantage of it if it happens.
Yeah, it feels to me like the Fed's a bit stuck because they can't raise interest rates too much without crashing the market, but then they can't keep printing money now that inflation's at a 40-year high. So if there is a crash, what can or will the Fed be able to do? So
it would partially depend on what inflation is doing. If you see inflation maybe still hot, but it's maybe cooling off by that point, so it's a lower headline CPI or PCE than it is now, they could have some ammunition to come in and maybe do some more quantitative easing, for example. They have other programs in place too. They have repo, they have reverse repo. They could potentially reliquify the corporate market, the corporate bond market. So there are tools they can do. I think the bigger tools to look at, though, are fiscal policy. So people often, I think, assign too much power to the Fed, whereas a lot of what can drive markets and inflation and things like that is fiscal policy. So I think watching Congress, U.S. Congress, to see whether or not they pass some version of the Build Back Better plan. Right now, that's kind of been in limbo, right, because they had trouble getting votes in the Senate. But there are parts of that if passed, it would expand the money supply. It probably would increase nominal GDP, but also potentially increase inflation. So there's trade-offs there, and it's important, I think, to watch from a macro perspective. We're also seeing that for 2021, China was kind of the oddball compared to the rest of the world, because the rest of the world was still very, very loose, whereas they were tightening conditions. So they had a declining credit impulse. They were cracking down on their tech companies. They were purposely trying to deflate some of their real estate bubble, because China's got this huge real estate bubble, very leveraged. Whereas that seems like it's bottoming out. If you look at the Chinese credit impulse, it's kind of showing signs of bottoming out. If you also look at, politically, they have their 2022 National Congress, which is their every 5-year kind of reappointment of leaders. So it's kind of a politically sensitive year for them. They wouldn't want, very tough kind of conditions during that type of, in the lead up to that event. So I think 2022, you could see China potentially holding up markets to some extent as well, kind of reinflating some of the globe. So I think I would look more towards U.S. fiscal policy, European fiscal policy, and Chinese overall monetary and fiscal policy compared to just looking at the Fed. So I would say somewhere in the middle. I think one of the biggest challenges with the growth camp, let's say the Cathie Woods camp, is that a couple things. One is we've had this kind of exponential growth from Moore's law, right? So semiconductors keep getting more and more efficient, and then software has absolutely blossomed for decades. The internet, and then mobile internet, and then all the applications we built. And so that's been a very exponential area of growth. And I think it's a mistake when people apply that logic to hardware, especially coming from an engineering background. I just know there's so many more constraints for things in the real world. And an example I like to point out is that the fastest passenger jet was built in 1969, and we still haven't built a faster one, right? So we're 50 years later. People back then thought by now we would look like the Jets, and we can't do it with what they did back then. The fastest manned military jet was the Blackbird. That was also like 50 years ago, 60 years ago. I forget the exact date. We United States went through a period where we stopped the shuttle program but we delayed the next one. And so we had a 9-year period where we had to pay the Russians to bring American astronauts into space for the International Space Station, because we couldn't really do it. And so hardware and things like that tend to not be as exponential as people suspect. I'm also watching the commodity shortages, kind of the structural shortages as it relates to copper, nickel, even oil and gas to some extent, compared to the estimates that they're going to be using in, say, 2030. And so I think we're going to be running into some, commodity constraints along the way to some of those visions of the future. And so I think that's a challenge. Also, I think a lot, especially earlier this year, a lot of like the ARC kind of Cathie Wood type of investments were very, very expensive. She had tremendous performance, partly because they went up very, very high, both in terms of growth, but also valuation on that growth. And so this year we've seen a big cooling off of valuation, even though ironically they're still high compared to, traditional valuation metrics. So they're still pricing in a tremendous amount of growth, even though it's perhaps less bubbly than it was before. So actually some of those names are perhaps more attractive now. I think some of the ARC growth stocks could do pretty well next year or 2 years. So I share some views with her, but I'm a lot more cautious about things that apply to hardware. And when it comes to Burry, I do think that most assets are bubble-like. I do think that the S&P 500 is unlikely to have great returns over, say, the next 10 years. I think some of the Nasdaq stocks, again, I think they're very, very expensive. I think bonds are overvalued. It kind of goes into the whole cash is trash thing. I think basically bonds, their yields are below the inflation rate. I think that if you hold bonds for the next 10 years, you're not likely to do very well in terms of purchasing power terms. Real estate in many countries is very, very expensive. In the US, it's less of a bubble than elsewhere, perhaps, but it's still expensive. And so I do think that there is, kind of an idea of an everything bubble. I think also the meme stocks and some of the cryptos have been very bubble-like, and that they're pro. In any given crypto cycle, 99% of that stuff ends up not really making it to the next cycle, right? It's kind of this, we throw everything at the wall and see what sticks. And there's only a small percentage of things that stick. So I think there will be things that 5 years from now are far, far more valuable than they are now. But I think a lot of them will likely not be. And so the areas that I would say are not bubbles are things like healthcare stocks, again, basically some of the value stocks, but specifically value sectors that are not being heavily disrupted. Things that are just kind of cheap and not being heavily disrupted, and they just be kind of not exciting, right? So I think that that's the stuff that could kind of grind out better returns over a 5 to 10 year period compared to what people think. Whereas some of the really exciting stuff I think could stagnate. Now, I think that there's still exciting stuff, like whether it's Bitcoin or whether it's certain other things in the digital asset ecosystem. I still think they're going to do very well over a 10-year period, most likely. But I do think we're entering a period where people have to be pretty selective with what they own.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.